It's actually one of the big differences between the 70s and the 40s is that the 1970s, private and federal debt as a percentage of GDP were both pretty low. And so when you had inflation, you could raise interest rates to combat it. Whereas in the 40s, when you had very, very high public debts, and so when you string multiple of those business cycles together over multiple decades, you get higher highs and higher lows in terms of debt to GDP. And you get lower lows and lower highs for interest rates. And that's what allows them to have more and more debt. But that starts to run into issues once you hit zero rates or, in recent times, even mildly negative rates in some countries. And because there's not a lot of policy room to keep cutting rates, and debt is extraordinarily high at that point. Yes, I do think that fiat currencies are not very attractive in this current environment. So Ray Dalio, for example, referred to cash as trash, and I think that's, it's a colorful way of saying that, basically you're getting little to no interest rates, in some cases negative interest rates, to hold cash, and yet the inflation rate is in most countries positive, in some cases strongly positive, and so you're not keeping up with the rise in prices. And so if you're holding cash in a bank, probably 5 years from now, you're gonna have notably less purchasing power. Even if there's no major inflation spike or major kind of reset or something like that, just the sheer kind of losing points every year is a big issue. And that's actually already been happening over the past decade, where most of the past decade you did not get positive real yields by holding either T-bills or cash in a bank. And it's kind of accelerating here in the 2020s. And so I do think that overall, fiat currencies are not a good store of value, especially in this current environment. So again, the debt ceiling is about funding that's already been allocated. And so the real question has to be directed to: can we afford further stimulus? Can we afford these kind of structural budget deficits that we have? And so those are kind of two separate debates, because one is about kind of fixing forward spending patterns, and the other one is about paying for previously allocated funding patterns. But going to the bulk of the question, the short answer is no. Basically, at 30 trillion in debt, 5% interest rates, as you pointed out, that would be $1.5 trillion in interest payments, which is a very large percentage of both GDP and specifically of government revenues and government spending. It's actually one of the big differences between the 70s and the 40s is that the 1970s, private and federal debt as a percentage of GDP were both pretty low. And so when you had inflation, you could raise interest rates to combat it. Whereas in the 40s, when you had very, very high public debts, despite inflation, pretty much whatever you do, they couldn't raise interest rates. And so that's generally a pretty good case for holding real assets at this current time, because I think we're still on a path towards currency devaluation. And it could happen in bursts, or it can happen just over the course of a decade of having interest rates that are below the inflation rate. I think there are significant, there is a foundation for those concerns. And so overall, my base case probably look more like, after the late 60s, when we had very high equity valuations and we entered a more inflationary period, you had a really choppy sideways market. Basically, you had a ton of volatility, you had significant drawdowns, you had poor returns, you had very poor inflation-adjusted returns. And so overall, I'm kind of looking at that as kind of the lower end case for how this likely goes, where, I think that with, basically the way it's currently structured, I don't think you're going to have, like, say, a 1929 style crash, because that, in that environment, the dollar is pegged to gold. So basically what you're doing is you're pricing the S&P 500 or the Dow in gold, and that's going down significantly and staying down for a very long period of time. Whereas if you're pricing something in a denominator that itself is losing value, it's a little bit more fluid. It basically can soften some of those giant crashes. But overall, if you look at the S&P 500, by most metrics, we are either the most expensive we've been in terms of, say, the Buffett ratio, the market capitalization to GDP, whereas other metrics show that we're like the second most expensive we've ever been in terms of, say, the CAPE ratio. Basically, we're second to the dot-com bubble. And there's 5 to 10 indicators that you can look at, and most of them say number 1 or number 2. And so that's obviously a really big challenge for the forward returns of stocks. Because the United States runs these structural trade deficits, our natural tendency for the dollar is to weaken over time. It gets held up by these really big, kind of offshore U.S. debt cycles that happen, and that creates a lot of demand for it. And so we have these giant gyrations that are really based around the shifting monetary policy that's happening. And so that kind of sets like the big stage for why it happens. But then I have to kind of watch the quarter-to-quarter action to see if we're getting price confirmation and what other variables can cause kind of, multi-quarter or multi-year deviations from that big structural trend. Yeah, so normally in a recession, you see a private sector deleveraging and a public sector increasing their leverage, right? Because you have kind of public funds coming in to shore up unemployment and things like that, while a lot of weaker companies start going bankrupt, and bigger companies cut down on hiring and try to shore up their balance sheet. So the private economy never really deleverages as a percentage of GDP back to where they started that cycle. And so they only do a partial leveraging, let's call it halfway, and then they start building up leverage again. And so when you string multiple of those business cycles together over multiple decades, you get higher highs and higher lows in terms of debt to GDP. And you get lower lows and lower highs for interest rates. And that's what allows them to have more and more debt. But that starts to run into issues once you hit zero rates, or in recent times, even mildly negative rates in some countries. And because there's not a lot of policy room to keep cutting rates, and debt is extraordinarily high at that point. And so this cycle has been quite odd because we haven't really seen a lot of deleveraging. We've had a very compressed time frame, but we've still seen, of course, the massive explosion in public leverage. And so we've seen a sharp a rebound in a lot of asset prices, but we still going forward, we still have a credit cycle playing out. So we still have many weaker companies going bankrupt or being impaired, and that's going to take probably all of 2021 to sort out. And over going back to 2016, it depends on what time frame you look at. So we saw when the dollar became strong in late 2014, early 2015, that caused kind of a slowing growth worldwide, especially in emerging markets, and especially their commodities demand. And so that's where we kind of saw a pretty big pullback, especially in the natural resources sector. And then since then, when we had a weaker dollar, throughout 2017, we had a global rebound and more liquidity conditions, and but that rolled over in mid 2018, and so we re-entered a strong dollar environment. We started to get slowing global growth, declining GDP growth rates, and of course that came into a climax this year when we also got hit by the pandemic, and that kind of put the cherry on top and had a stepwise down function. Yeah, so basically we're all familiar with the short-term business cycle, which is the 5 to 10-year credit cycle of boom busts. But every time there's the end of one of those cycles, we have a deleveraging event, and then we have policymakers come in, they cut interest rates, they do all sorts of fiscal spending, and they kind of short circuit that deleveraging, where we kind of ran into the zero bound with extraordinarily high debt levels. And that's what's been called the long-term debt cycle. So Ray Dalio and others have popularized that term, and it's something that I've incorporated into my research pretty heavily. And if you then look at Neil Howe's work, the demographics, the history specialist, in his book The Fourth Turning, he showed that basically every 80 years or so, you have a really big kind of change in the way societies function. You kind of tear down old institutions and rebuild up new institutions. It's usually a very, very difficult time period. And I don't know if you knew it at the time, but all those fourth turnings line up with long-term debt cycles. It's just kind of how it works out, where we have kind of a and what separates a long-term debt cycle from a normal short-term cycle is that a long-term debt cycle is normally associated with currency devaluation. And so basically debts get so high that policymakers can't deleverage them without the system collapsing. You're getting little to no interest rates, in some cases negative interest rates, to hold cash, and $1.5 trillion in interest payments, which is a very large percentage of both GDP and specifically of government revenues and government spending. We still, going forward, we still have a credit cycle playing out. So we still have many weaker companies, going bankrupt. Policymakers come in, they cut interest rates, they do all sorts of fiscal spending, and they kind of short circuit that deleveraging.